Folks, welcome back to the Taylor Tax Show, the podcast for highly paid, highly taxed, high profile, ultra high net worth, and high net worth taxpayers who want to save a bunch on your taxes legally and perennially. I'm Terrence Taylor. I'm the co founder of Taylor Tax. This is Big Al Darnell Jr. Big Al, tell them a little bit about yourself.
What's going on, everybody? Well, I'm Big Al, and I love my mama.
All right. So, folks, this is episode 25, and today we're going to continue our series on taxes and retirement. And we've decided to do the next three podcasts as a series on the levels to the retirement planning and taxes game. And you'll see what we mean by game as we get into this. So, in level one, we're going to look at qualified plans. That's the episode today. Level two, we're going to look at equity center. This is all from Big Al. And level three, we're going to look at international exposure. So episode 25, which is going to kick off right now, we're going to talk about taxes and qualified retirement plans. And what we decided to do was to feature Tax Strategies GPT because we went and asked it as we were preparing for this episode to tell us what are the most tax advantage to the least tax advantage retirement plans. And it gave us a series of 9. So, Big Al, I'm going to share my screen and we're going to kick off by going back and forth looking at each of these plans. And if you don't mind, I would love for you to start with number 1. But first things first, let me share my screen.
Definitely, not a problem. And yeah, just like what Terrence was saying, what we figured out is that there's levels to this tax game. All right, and with these levels, what we wanted to do was break it down in digestible chunks for those that might be more risk averse at first. That's why we're starting off with the IRS qualified accounts or qualified plans. Next is the second level of game, tax game. It's going to be talking about equity centers, and then on our third portion of the series about taxes and retirement, jumping into little aspects of international exposure. So yeah, go back to you, Terrence.
Yeah, well, let's start with number 1. So we got defined benefit plans, right? So these are previously known as pension plans, folks. And the tax advantages is you could defer a lot, right? Also, the contributions used to be quite significant. And this is before we move to defined contribution, right?
Yep.
So what is the maximum contribution? So this is something that sometimes folks know and sometimes folks don't know. We just wanted to share with you quickly. So in these plans, defined benefit plans, these pension plans, it used to be the case that you could contribute over 200K per year, depending on things like your age and your salary. So what are some interesting details? You get a fixed benefit in retirement and it allows a lot of contribution. Really ideal for folks who are earning a lot of money or folks who are close to retirement. Big Al, anything you want to add to defined benefit plans before you tell us about solo 401ks?
Yeah,
And
yeah.
set.
So with
Mm.
defined benefit plans or pension plans, as we all know, especially with our parents, if they had a pretty solid job, they would have pensions involved, and those pensions could be up. That's probably the highest contribution amounts out of all the things that will go or qualified plans will go over, and those would be up to 100% of your average compensation for your for 3 consecutive calendar years. So I think for 2024 it could be up to $275,000 that could be contributed to this plan, which is by and large head and shoulders higher, almost 4 times higher than the next highest contribution. So, but as you know, most companies aren't doing that anymore. Most people aren't contributing that much anyway. But yeah, that's all I wanted to say about that. So if you have a very large company that pays you and you pay yourself a very large amount, you can create a pension plan. Just make sure that you work with the payroll company and the HR to make sure that if you set this up, I believe you might have to set it up for every employee that you have as well. All right. So make sure that you understand how that works before you jump into it. But yeah, that's the first one.
All right, Big Al, tell us about the solo 401k.
Yeah, with the solo 401k, these are primarily for solo, as it says, solo employer, self-employed. So what this means with a solo 401k, you could contribute up to around 69,000. And what we did was group in the solo 401k, the SEP IRA, and the simple IRA. These are all for self-employed individuals, meaning that you're not working for some company that you have no ownership in, and you're not in a company that has over 100 employees either. We're talking about usually one person, just you, or just very few, probably less than 7 or 8. Now, in this situation with a solo 401k, you could contribute the absolute max. I believe it was 23,000 for the employee, but you get to contribute the employer's standpoint too, which is what jumps you up to 69,000. And the same thing with a SEP IRA. SEP IRA, what that's going to be is up to 25% of your compensation, or that maximum amount of $69,000. And let's see, yeah, $69,000. And then with the simple IRA, with this one, it's very similar to the SEP, except there are some contribution matches that you have to do. So if you have 2 or 3 employees, I believe that you have to match the first 3% or the first 2%, or something of that nature. It just adds a higher level of complexity, but you'd have to, I think, put in 3% even if the employee doesn't put any money in. That's what it is. So that's the second one. And the reason we say that's the second one is because what you could do is that you could contribute a lot more than what you can with some of the other situations. When it's just you yourself, you can play the part of the employee and the employer and max out what you put into that retirement plan.
Yeah. And Big Al, just so you know, Tax Strategies GPT is given a maximum of 73,500 for the solo 401k, and it's saying that the SEP IRA, the maximum would be 66,000.
Okay.
And um, and the beautiful thing, as you shared, is the reason why this is such a good plan from a tax point of view is the tax deferred growth, right?
Yeah.
And another aspect is the contribution that you make because you're doing this as a self-employed individual could potentially be deductible on your tax return. So
Yeah.
this is
That's
fantastic.
right.
That's a
That's right.
win-win-win. Yeah,
Yeah.
right. And obviously, because you're able to set it up and follow the rules, you also could maximize as much of that tax deferred contribution as possible. So much more than the regular 401k. So big, I'm going to take the next one, the health savings
Great.
account. I love this because this is a triple threat, folks. This allows you to save in 3 ways in terms of taxes. So the deductions are the contributions, sorry, are deductible. The growth in the plan is tax free. And when you withdraw the money for qualified medical expenses, is also tax free. Our hero, Mark J. Kohler, again, shout out to Mark J. Kohler, and thanks for telling us, Big Al, that he did this. He built up HSA to the point where he was able to invest in rental real estate. So now the HSA is getting income from the rental real estate, and he's able to use those funds to take care of his family's medical needs. Okay, max contribution. I think these are 2024 numbers. $4,150 for individuals, double that, or 8,300 for families. And for those of us, well, I'm not quite there yet. For those who are 55 or older, you can add an extra 1,000. Okay, and let's see. You could use these funds tax-free for medical expenses at any age, which is absolutely amazing. And once you get to 65, there's even more flexibility. All right, Big Al, anything to add for this one before you tell us about the Roth 401k?
No. Oh, yes, there is. So with the HSA, the solo 401k, and so forth that we've already discussed, not the defined benefit plan, but the solo 401k, SEP and simple, as well as the HSA, what we're talking about is not just the contributions to them, but also if you want to go a layer further, self-directing the investment, what they're investing in. All right. And that's where Terrence came to mention Mark J. Kohler, the reference that Mark J. Kohler made about investing the amount that he had in his HSA into a rental property and that earning money inside of the protective covering of the HSA account. So make sure that you look a bit further into not just contributing, that's one level, but another level would be to contribute as well as self-direct the investments in it. And there is some auditing and another two steps involved to make sure that everything stays within compliance for this qualified plan. But yeah, that's how you would do it. All right, back to you, Terrence.
Cool. Back to you, Big Al. Tell us about the Roth 401k.
So the Roth 401k, the beautiful thing is that, for the longest, all we had was a Roth IRA as a tax defer or as a vehicle to put after tax dollars in that grows tax free. Now what they've done is they've kind of combined the best of both worlds with a Roth 401k. Kind of look at it as like them having an S corp and an LLC, but now a LLC taxed as an S corp. So you get the benefits of the higher contribution limit as a 401k, which is like $23,000 for the employees portion. But then you also have the higher amount as a 401. The higher amount is a 401k, but the tax free growth like a Roth IRA. That's what I meant to say. So yeah, so those are that is a huge benefit for those that have a Roth 401k.
Cool. I can't remember if you also told him about the maximum contribution amount.
No, I didn't. I didn't. Maximum contribution. Yeah, could you hit that?
Yeah, sure. And that would help me to transition to the Roth IRA. So the maximum contribution for this folks is 30,000 and if you're 50 and above, and 22,500 if you're under 50, right? And this has to, like as Big Al said, include any amount that the employer matches. All right, folks, let's look at the Roth IRA in the middle of the pack. So you wouldn't think something that has Roth in front of it would be in the middle of the pack when it comes to tax benefits for retirements, but this one does. But okay, let's look at the positive. So the positive is it is tax advantage in the sense that you get tax-free growth and tax-free withdrawals in retirement, right? But the after-tax contributions do grow tax-free. They provide substantial long-term savings. That's not the but. The but is the amount that you could actually save each year. Big Al, 7,000 a year, 6,500 if you're under 50. So folks, if you're trying to save for retirement where to be able to take out 10,000 every month, you need to save at least $2.5 million. Having to have being limited to saving 7,000 each year is really, really going to make it difficult for you to reach the numbers that you need to have saved in retirement. So despite the fact that it is a Roth, so you get the tax-free growth and tax-free withdrawal, sadly, you can't save too much money in this. All right, Big Al, anything to add on this one?
No, that's right on the head of the nail.
All right, cool. Tell us about number six, the 401k and the 403b plans.
Yeah, so with the 401k, 403b, we can also add in the TSP, which is a thrift savings plan for those service members that serve in the military for us. Thank you for your service. As well as 403b, 403bs, 401ks, TSPs, and I believe 457s. So with these plans, these are the traditional it retirement plans where the amounts that you contribute from your paycheck reduce the amount that they're going to report on your W-2 from taxable income. And what that does is if you're in a high income job, it allows you to have $23,000 less that you have to pay taxes on that very same year. So I guess if you're in the 37% tax bracket, then that comes out to being maybe $6,000 or $7,000 that you get to avoiding taxes. So that it gives you more of an immediate benefit, but not the long term compounding or benefit from the compounded earnings of the contribution because you're going to have to pay taxes on the earnings afterwards. So that's why this is so close to the bottom of the list.
Okay, cool. And I think you may have touched on it, but the maximum contribution again, folks, 30,000 if you're over 50 and 22,500 if you're under. But I think you did touch that. Let's talk about number 7, Big Al, traditional IRAs, traditional individual retirement accounts. So this is the one that most people, this is probably the second most known plan after the 401k, right? And so it works very similar to what we already discussed in terms of the Roth IRA. So the difference here, though, is that the contributions, when you withdraw them, will be taxed, right? So advantages are you might be able to deduct some of your contributions depending on your adjusted gross income. And you do, of course, get the tax deferred growth. But one thing that we haven't really touched on, Big Al, is the reason why we personally feel as tax professionals that the tax deferred growth may not be as beneficial as it once was. And this is the understanding that most likely in the future, tax rates are going to go up significantly. We don't know exactly when, but it's a matter of when, not if, right?
Yeah.
Congressional Budget Office has already told the government that it needs to increase tax rates and almost double them to make up for the budget deficits. But I digress. Let me come back to traditional IRA. So maximum contribution 7K, 6,500 if you're under 50, so similar to the Roth IRA. And contributions may reduce your current taxable income. Withdrawals in retirements are going to be taxed
But look,
as.
that was a good digression because if you really
Mm,
think about it, with the strategies that we're trying to give, my man,
mm-hmm.
we are people should be getting paid more than what they are getting paid now during the retirement. All right.
All right.
So that might bump them back up into a higher tax bracket when we've created situations where within certain limitations you're paying close to zero in taxes. Do you follow what I'm saying? Because
Yep.
there are capital gain amounts that you can make where if it's under this threshold, it's still 0%.
Mm-hmm.
And other things that we're doing as well, but yet and still, no, that was a good digression. We could go
Okay.
into the next one though.
Appreciate you. Appreciate you. So, Big Al, why
Um,
don't you tell us about number 8, the taxable brokerage account?
yeah. So with the tax, matter of fact, I'll hit up the last two, 8 and 9,
Okay, go for it.
taxable brokerage account and the traditional savings account. Here's the thing; those are at the bottom of the list because a lot of people talk about retirement being like a three-legged stool. And with
Mm-hmm.
that three-legged stool, they talk about, hey, you have your qualified accounts like a 401k. Then you also have your savings or your investments, which is what these last two are. And then the third would be Social Security, which really ain't none of us really counting on for real like that. Like, like, be real. We're talking about $2,500 a month, and you're supposed to survive off of that. And with ex- increased medical costs and all the other aspects of inflation, and then whether or not it's even going to be around 10, 15, 20 years from now. So that's that three-legged stool. Qualified retirement account, a traditional savings or brokerage account where you do your personal investments, and then Social Security. So that's what these two represent. So the brokerage account, that's where you invest your money into like a Charles Schwab, Fidelity, Robinhood, even, and then the earnings on it, you're gonna be taxed just like regular income. There's no tax benefit at all. Same thing with a savings account. Savings account, the money's already been taxed, but any earnings, interest that you earn off it, it's gonna be taxed again. So these are, it's almost like a negative tax benefit. So that's what those last two are.
Yeah, and Big Al, just to jump in with some stats, and I will confirm them, but if I recall, in some of the conversations we have when we're talking to people about how money works and just understanding what folks in the U.S. tend to put their money into, I was shocked to learn that most Americans have over 80% of their money in traditional savings account. And when we talk about the tax benefits of doing things like saving for retirement or investing, and also making sure that you can get the tax deductions, it boggles the mind that we are, as a nation, so geared towards saving in traditional savings account, which don't really give us a lot of tax benefits. Now, of course, it's a trade-off. I get it. So folks are most likely saving because that's what we've been taught to do, and saving in that way. And also we feel that, hey, if anything happens, I have access to my money, right?
Mhm.
So, but the trade-off is you get no tax benefits. And then I think the stats also show that like about 15% of folks
Yeah.
tend to invest in
Yeah.
stocks. So that's where the brokerage accounts come in. But unless you do some elections to make that a tax advantaged um, vehicle for yourself, you also are not getting any tax benefits from that. So you need to make an election to be treated as a trader, professional trader, to be able to get some tax benefits where you can save a bunch of money on the expenses that you would incur in your trades, and even be able to recoup losses as losses to reduce your income. That's probably a separate video. I know we've touched on this in other conversations. So for example, the episode when we talked about what you should do with your bonus, and how you should take your bonus and
Hmm.
take save, take, uh, claim your full bonus, and then use 50% of it to trade and invest. And we talked about brokerage accounts. Okay, so Big Al, let's close and just look at some of the key takeaways. So the most tax advantage, your defined benefit plans and accounts with high contribution limits. So we talked
Correct.
about HSA, Roth, 401ks especially. And then we looked at also some of those solo 401ks and SEP and simple IRAs. So for the self-employed, least tax advantage is what we're touching on, folks. Regular savings and tax brokerage accounts don't really give you much. All right, folks. So this is the first level.
Yeah.
We will talk you through the second and third levels. And Big Al, take us home. What do you want to say in closing?
Well, I'll say this is that remember when we're talking about taxes and retirement,
Mhm.
as you know, the tax code is so verbose. It's so big. The two main things that you need to make sure that you understand is number one, what's the purpose? What's your goal in retirement? And then from that goal, then we can come up with a tax plan based on your time horizon. All right. So the goal, time, and using taxes to take advantage of the time to get to your goal, so on and so forth. Because there's so many ways that we can turn this and move it and modify it in order for you to accomplish your goal. Some people don't ever want to retire. Some people want to retire post haste. All right. And some people will say, hey, look, I'll retire at 65, just like our propaganda has told us that we should retire at 65 or 70 or whatnot. But for whatever that is, that's on you and that's cool. But as long as you know what that is and what you're trying to do during retirement, with whatever time that's left, be it 2 years or 25 or 40 years, we can help you navigate your taxes in a way to get there. But just know this: it might not be level one if you've got a very small time horizon. So make sure that you look forward to or catch us for the level two tax game when it comes to retirement savings or saving for retirement. But that's it for me, Terrence.
All right, cool. Well, since you mentioned folks reaching out to us, let's just give them the email addresses. So here
Yeah.
on Tax Strategies GPT, you see mine, Terrence at TaylorTax.ai, and you can reach out to Big Al at Big Al at TaylorTax.ai. All right, folks. Thanks, and see you soon.
Cheers.